There are other classes that are really get influence in markets. I really want to this.
Yeah, it's funny, you both mentioning each other in the last few days.
That is a very good model.
Yeah,
Yeah.
very sharp.
What do you think about debt?
Bruce, fixed income side
For a long time.
He was actually having my question for a while. He headed fixed income at investment bank for a while. So inside and outside. Most important agents. Standardized. I mean, it's very interesting. But he does teach it as he teaches, I think, in 2 semesters, not just the summer. So
I emailed him.
okay, folks, second to last class. No reminder needed, but I'm going to give it anyway. Your final project is due on Monday at 5. Use the close of trading price as of Friday when you do the final number, which means that between now and Friday, your recommendation can change. Your stock can drop 30%, it can increase 30%. So that's out of your control. Your value and price, though, don't try to change them on a continuous basis from now through Friday. You're going to drive yourself crazy. The second thing is please do get the numbers into that Google shared spreadsheet, the master sheet, by Sunday, because I will download that sheet and make that the basis for Monday's class. So today's class, we're going to talk about changing value. You think, haven't we been talking about value? We've been talking about valuing things all the way through this class, value companies. But today I'm going to, but we've been talking about it as investors looking at companies. Today, we're going to break the door open and jump into the company. Say, are there things we can do in a company to change its value? So if you think about what your job is as a CEO, CFO, somebody in a company, your job is to increase value. If you think about from a consulting perspective, why McKinsey or Bain, and if you're in the truest sense of the word, you might be doing something specific, but the question I'm asking, what can we do to increase value? So if you're interested in the business side or the consulting side, this session kind of links up valuation to those particular choices. So today I want to start off by asking you a few questions about value enhancement. You guys have the tools to essentially slam dunk these questions. So here's the first question. When companies take all kinds of actions, they call all these actions value enhancing. And of course, analysts go along. So as I go through each of these actions, I want you to think about, will it change the value of a company, right? The proposition you need to remember to do is the proposition. If it does not affect the cash flows and it does not affect risk, it cannot affect value. Let's start with the stock split. Stock right now, NVIDIA doing a stock split this morning. I read on CNBC. This is amazing news for the company. We should be buying the stock now. And stock split, increase value, decrease value, no effect on value. And tell me why. What does it change? The number of units in the company, right? So what is that CNBC story all about? Because it's not a fool writing the story. What are they talking about?
Increases liquidity.
Pricing choice. Effectively, this is why we draw that contrast. Could splits have a pricing effect? Absolutely. The pricing effect could show up as a 3% jump or a 5% jump. It could even send out pricing signals about this. So it could have a pricing effect, but no value. How about amortizing goodwill? Think of how much time. I mean, yesterday I was talking to a group of accountants, and we're talking about what percentage of the time, and these are the big 4 accounting firms, what percentage of appraisals are these fair value re-estimates, and how much time they spend on goodwill and its impairment. First, what does that mean, impairing goodwill? What do, under what conditions do accountants have to? First, goodwill is created when you do an acquisition. It's what you pay over and above the book value, right? So what is this impairment thing? Matthew?
It encourages the spreading of that goodwill over time.
No, that's not it. That's what it used to be. That was amortizing goodwill. It was an autopilot. You took it and wrote it off. Today, you can have goodwill that stays as goodwill for the rest of eternity, right? Dor?
Very good.
That they screwed up, right? And how do accountants come to that conclusion? What do you think they do? They claim to do valuation, but I'll tell you what they do. They look at the pricing. Let's say you bought, shares in tech companies at the peak of the small tech company boom. They're down 30% right now, so the accountant has to figure out a way to show a 30% drop in what you held. Impairment happens because the pricing reflects the fact that you made a mistake. So can impairing goodwill, so sometimes this number can be billions of dollars. Does it affect value? Justin, what do you think?
Expensive.
But expensing by itself, but is it a real expense? It's a non-cash expense. Is it like depreciation though? Because depreciation, even though it's a non-cash expense, affects cash flows, right? Why? Because depreciation is tax deductible. So the real question is goodwill impairment affect my taxes? If it does, it could affect value. And 95% of goodwill impairment is not tax deductible in much of the world. This is one of the most useless exercises known to man. Because by the time the accountants tell you you've screwed up, everybody knows you've screwed up, right? It's 2 years after the fact. It has no effect on your cash flows. It definitely doesn't change your operating risk as a company. The real question is, and it's not a question that I have an answer to, is why are we wasting our time? Why are we spending so much paying accountants to impair something that nobody cares about? It's a make work for accountants act, and I'm okay with that. Accountants need jobs too. But the truth is, this is and this is why when accountants say, well, I'm impairing goodwill, what's the right cost of capital? My reaction is, who cares? Make up a number, move on, get the checkbox going. Impairing goodwill doesn't affect value. Does it affect price? I actually did take a look at goodwill impairments and what the price reaction is. No price reaction either. Investors have basically said, we know that already. What about changing depreciation methods from some kind of, straight line to accelerated or accelerated, but, only in your reporting books. Companies do this all the time. This dance of, FIFO to LIFO, but only in the reporting books. Why do they do it again? What do they want to show in their reporting books? Higher earnings or lower earnings? They want higher earnings, so basically they go to straight line. But if your tax books are unchanged, this is a dance that really doesn't affect cash flows, doesn't affect risk. Does it affect stock prices? Even investors, traders are not that naive. You change the depreciation method, you report 5 cents higher earnings per share. Nobody is fooled for beyond like 15 seconds. This was in the dot-com boom. One of the things that companies, established status quo companies, they felt they were being left out of the game. So what they started doing, New York Times did this, DLJ did it, they created what were called tracking stock. What does tracking stock do? It took the dot-com portion of the New York Times and created shares against it. You think that's great? The only thing is, if you buy these shares, the business was still owned by the New York Times. You got no corporate governance rights, but you got a piece of a dot-com slice. You can see why companies did it, right? From a valuation perspective, you're the New York Times, you own this online part of the business, you issue tracking stock against that online business. That's all you've done. Does the issue of tracking stock make you a more valuable business? It's the same business, right? But could it affect the pricing? Yeah, you're in the dot-com boom. You put anything .com, people pay a 50% premium. I will predict that there will be AI tracking stock. Because if you're paying 10 times revenues, and I'm a company trading at 1.5 times revenues, I am tempted, right? Walmart AI. I don't even know what that means. Now, you have no control over what they report, but this is coming. It is as old as time. There's a pricing effect. So the answer there is none of those actions. You know how much time companies spend on things that don't affect value, that could affect the price? So today we're going to talk about that contrast between price enhancement and value enhancement. Second question, this is, I think, this is one where I want you to start thinking about preconceptions. Let's suppose you've been appointed as a CEO for a multi-business company. It's in trouble. So you want to shake up the company. They're in four, and I give you the four businesses they're in. I give you the return on capital in each business, the cost of capital of each business. You as a CEO want to take an action that'll enhance your value for your shareholders. And you think about selling off one of the businesses. Which of these four businesses would you sell off? Blooded? And why?
It's not returning.
It's a terrible business, right? But I actually think I would sell A, which is my best. This is not what corporate strategy class is. Get rid of the bad businesses. But what's the effective value of divesting something? It's the price you get relative to the value of that business. Does everybody know D is your bad business? Yeah, so when you go to sell, they say, you're selling me crap. I'll pay you crap for crap. You know why? If you have your best business and it's in this sector where people are overpaying, your chance of getting a pricing higher than the value is actually greatest on your star businesses. It goes against the grain, but the effect on value doesn't come from selling bad stuff. It's what you receive in response. Isaac?
That is in thinking like short term rather than.
No, this is long term. What's value? It's the ultimate. How do I value a business? I look at the long term value. And in a sense, you might actually argue that the pricing impact is going to, if you're thinking short term, those businesses will be priced even lower than the value because you're reacting to bad news and bad news and bad news. So pricing is driven by short term, but that short term will work in your favor in the best businesses. It'll work against you in the worst businesses.
But then you have cash and then a lot of that performing bits after the sale of.
No, but in a sense, there's nothing you can do. What's your alternative? You're in a bad business, you can't get out of it, you're still earning some money, you can't get your invested capital back. Remember, you can't liquidate the assets and give me back the book capital. So in your sense, trapped, you're right, you're trapped in a bad business. You shouldn't try to grow that business. You don't want to be the CEO of this declining company, but it's better than selling off your worst businesses for well below what they're worth, because that, or at least just keep them. Don't sell them for less than it's worth. So if you decide you don't want to divest anything, I'm okay with that. But it should be the price versus the value. Question? Yeah. And that, I think that's part of the reason CEOs don't like to do it. You end up at the head of a company that is slow growth, bad businesses, and nobody wants to be the CEO of that. But the truth is, from your shareholders' perspective, you want to sell something, you want to sell the business where you get the higher price. Yes.
The reason you're willing to hold on to business maybe is because the cost of capital is just like a risk assessment.
In a sense, the cost of it's a bad business. I accept it's a bad business, but I can't get out of the business, right? You're in the airline business. What the heck are you going to do? Right? You're going to sell the airline business. People are going to pay you, basically the fact that it's a bad business. I think this, the liquidation choice comes from the fact that people think you can get book value back when you liquidate a company. And with bad businesses, I can almost guarantee you that that's not going to happen. One final question. Yes, go ahead, Matt.
Is that like why a big box retailer like Sears or Macy's would profitability and keep their underlying business?
There's desperation behind it, right? They need the cash now. If they don't get it, they're going to go out of business. But if they were thinking sensibly, they might, that might be exactly why. That's the only valuable part, right? Who wants a store that nobody comes into, right? So I don't even think they had a choice. Because if they tried to sell the store of the real estate, people have laughed at them, right? So there it became obvious, but sometimes it's not that obvious, and you sell off this bad business for well below what you could have made by keeping it and collecting the cash flows. And finally, let's talk about dividends and buybacks. There, I've heard from, CFO saying, will I make a higher net present value by taking a project, or will I make a higher net present value by buying my own stock? And here's what drives it, right? You buy your stock at a market price. If it's lower than what you think the intrinsic value is, you're effectively buying. So they take the difference. And I have to explain that the second net present value is a fake net present value. And here's what I mean by that. The first one, when you take a project with a positive net present value, actually creates value. It's an operating increase. The second one, it looks like you have a net present value that's positive, but it's really a wealth transfer. Do you see what I mean by wealth transfer? You basically are buying back shares from some of your shareholders. Your remaining shareholders benefit because you've transferred the wealth. The company itself hasn't become more valuable. Cash return, dividends and buybacks cannot create value. They're cash return. Doesn't mean that it doesn't make sense to do that, but don't do it because you think it's good for your company and increasing your value. You're just transferring wealth, and be transparent about who you're transferring it from. You might say, look, I don't care about those people who sell their shares back. I care about the people who remain. I'm okay with this wealth transfer, but cash returns at best can create value transfers. So let's go back and finish the acquisition part. And let's face it, I mean, if you're going into M&A, that was not the, yes, go ahead.
But just in terms of the buyback versus
Yeah. Dividends.
dividend decision, a lot of people.
It depends. So tell me, first, most of the strong feelings are about things that they shouldn't have strong feelings on, right? What's the strongest feeling on? That this cash, it's but there's nothing wrong with signaling the truth, right? If you're overweight and you wear loose clothes, you might signal I'm overweight, but it's a good thing to signal because you want more room. I think that signaling the truth is never wrong. So if you're in a low growth business, signaling that you have low growth actually is good. I think if you look at what Google and Facebook have done just in the last quarter, announcing dividends, they're signaling we're mature. And that's a good signal to send because they want a different investor base in them. If you're signaling low growth when you have high growth opportunities, then I have a problem. But the problem there is not with cash, with buybacks and dividends. It was the managers choosing to return cash when they have all these other needs that they've got to cater to. So but from a shareholder perspective, you can make arguments for one versus the other. So Colton, you be the shareholder. When I pay dividends, what happens? You receive the dividend. You don't have a choice. You pay taxes. You don't have a choice. And if you're, older and you have lower income, you might say, I'm okay with it because my taxes are low. I need the cash. It's good to get the check in the mail, or I don't know how it's even deposited right into my bank account. But if you're younger and you don't need the cash, and you're going to look at the dividend and say, this is cash I don't need. I'm paying taxes on something I don't need. The difference between dividends and buybacks is buybacks go to that group that sells their shares back and wants to collect the capital gains. The rest of them just get this unrealized capital gains. And as long as unrealized capital gains don't get taxed, and there's talk about doing that, but if you're going to say, look, I prefer buybacks. So you can already see that companies acquire investors who like what they do. So for Verizon, over time, you've accumulated a group of shareholders who like dividends. Doesn't mean they're irrational. They might be older. They might be pension funds. So if you ask me, should I pay dividends or buy back stock? I say, given your history and you hold this cash, pay it as a special dividend or increased dividends. But if you're a company that's never paid dividends, you got to tiptoe into this space, right? Google and Facebook, if you look at their dividends, it's like 0.2% of the price. If they had paid a dividend, which is 5% of the price, you'd have a revolt on your hands. Because I'm a Google and a Facebook shareholder. The last thing I want is big dividends coming into my account I have to pay taxes on. So the dividend versus buyback is really about what would shareholders in your company prefer. And if they prefer one over the other, give more of that. No. But from the company's perspective, there's actually no difference between the two. Yes, Isaac.
When you have like a company that's stock is underperforming, and then you have positive NPV projects, like it's not an opportunity cost where to decide if you spend your cash on one or
No, but
another.
be very careful. When you underperform is when you deliver less than expectations, right? what your stock does and what the quality of your projects are is actually uncorrelated. That sounds like a weird thing. Because what your stock does is how do you perform relative to expectation? I'll give you an example. Let's suppose you're a company that historically has taken projects that earn 25% returns on capital when your cost of capital is 8%. I priced it on that basis. Let's suppose your return on capital goes from 25 to 20%. You still have positive net present value projects, right? But you know what's going to happen to your stock price? It's going to go down. So we have to separate what happens to the stock price, which is based on this expectations game, and what happens on individual projects, because you're measuring two different things. But that positive net present value rule doesn't change based on what happened to the project. You can't change the fact that your business is in fact getting less attractive. And the market price is going to reflect that change. So price, what happens in the market is relative to expectations. NVIDIA, suppose I think earnings report comes out this evening. I mean, you know how high expectations are about this report? It's terrifying. And if I'm NVIDIA, this is something I'm going to have to fight, not just the earnings report. As people's expectations go up, they're going to price you high. That's the good news. The bad news is you now have to meet those expectations. So I think separating out how good are my projects from what's happening to my stock is a good way to think about why that divergence can happen. So last session, we were talking about acquisitions, and if any of you are planning to go on an M&A, you probably left that session pretty depressed, right? Lots of bad stuff coming. There's a glimmer of hope. I'll talk about that. But let me finish up the discussion of the 7 deadly sins in acquisitions. We talked about synergy. We talked about where it can come from. It can be operating synergy or financial synergy. If you want to value synergy, you got to go through a 3-step process. First, you got to value the 2 firms involved in the merger separately as standalone firms. You cannot value synergy by just looking at the target company. So when you see a banking valuation claiming to value synergy and all you see is the target company in there, no way, you cannot do it. You value the 2 companies standing alone. Second step, you just add those 2 numbers together. Present values are additive. So if I value the first company at 100 billion, the second company at 50 billion, I add the 2 together, I get 150 billion. What is that? That's what the value of the combined company would be if there were no synergy. And then the third step, I throw in everything but the kitchen sink. So lower costs, I'll bring in higher margins, higher growth, lower cost of capital. And in step 3, I value the combined company with all of the benefits of synergy you've talked about. And if there is synergy in step 3, that value you get should be higher than the value you got in step 2. That difference is the value of synergy. So let me give you an example from way back in time. One of the biggest consumer product mergers of all time, Procter & Gamble, then the largest consumer product company in the world, bought Gillette, 6th largest consumer product company in the world. And talk of synergy filled the air. So the first column, I have my valuation of equity in Procter & Gamble, and second column, my valuation of equity in Gillette. 221 plus 60 billion is about 2. So if you had no synergy, the combined value should be 281 billion. So just basically 2 status quo valuations. I didn't know what to call the combined company. I decided to call it P&G, Gillette, Piglet. No, that's not the name they picked. They stayed with P&G. I think Piglet would be a better name. But Piglet with no synergy is 281 billion. And then I took everything managers claimed they would do and assumed they could do it instantaneously. You know how optimistic that is? In most cases, when companies claim they will cut costs by 200 million, and McKinsey's actually looked at the, you know what percent of companies actually cut costs? That much? Probably 10%. Most companies come in lower. So I'm going to assume that when you tell me you're going to cut costs by 250 million, not only do you mean it, you will deliver and you will do it overnight. That's the second assumption. In the real world, cutting costs can extend over 2 or 3 or 4 years because it takes a while. So think of this as the best case valuation of synergy. The 250 million lower cost just shows up as higher operating income. It just translates directly into my operating income. The slightly higher growth rate, you're saying, why only slightly higher? You're the biggest consumer product company, you buy the 6th largest. You're not going to get a big jump in your growth rate. You're just way too big. So I put in a slightly higher growth rate by about 0.92%. That, percentages can be deceptive. That is an extra few billion in growth each year, and that's going to build up over time. There's the value of my combined company with the synergy built in, assuming the synergy starts instantly. You know what that difference is? That's my value of synergy. There's a canard that in finance, we don't value synergy at all. That's not true. I'm valuing synergy at 17.2 billion. So this must be a good merger, right? What determines, because Procter & Gamble is the acquirer, what will determine if as a Procter & Gamble shareholder, you come out as a winner or a loser from this deal? Justin, what you pay, right? You know what Procter & Gamble paid as a premium for Gillette? 25 billion. This is why mergers fail. It's not because good stuff doesn't happen, but if you pay for all of the good stuff plus 30% more, how do you end up winning on this battle? I talked to somebody at P&G who's involved in this deal and said, why do you guys go through it? He said, because that's what we had to pay to get the deal done. And that is at the heart of the problem. Why is getting the deal done the end game? I thought it was getting a good deal done. But this is something that happens. Once the deal starts to, the wheels get greased, the bankers get involved, and everybody's pushing. You don't want to be the skunk at the party saying, maybe, guys, we should back out of this deal. It's a problem, but it's a problem that you see over and over again. Let's take a more explicit example of synergy. This was when Best Buy was still kind of growing. I mean, it's run into its own brick and mortar retail problems. When it was a growing electronics company. And it was, let's say it's planning to buy Zenith. There was a time in the US where if you walked into homes, you saw Zenith TVs, they were all over. By the time this was done, Zenith, the only only asset it had was a lot of losses that had accumulated over time. It's a bad place to be. You say, what about the brand name? If you're 25, you walk in and you see a Zenith, you say, what's a Zenith, right? It's not exactly a recognizable brand. It's not a Samsung, it's not a Sony. So there's no brand name value. All you have is an NOL, 2 billion. Let's assume you can get the tax okay. Your Best Buy, you buy Zenith, and the only asset you get is a $2 billion NOL. If your marginal tax rate is 36%, what's the value of synergy? What's the value of Zenith to you? 36% of 2 billion, which is 720 million, right? Let's say though, but remember that the IRS doesn't mail you a check for 720 million. You need to have income so let's say only $500 million in income as Best Buy, and that's what you expect to have as taxable income for the next 5 years. Now what happens to the present value or the value of this? The 720 will come in 5 installments, and you've got to discount them back to them. At what rate? What's a question we need to ask about discount rates? Where is the risk? How much? What's the risk that you will not be able to get the tax benefit? It's not in the 2 billion. That. It's not in what will happen to Zenith. There's nothing there. It's in whether you, as Best Buy, will have enough taxable income to cover it. You know what you should be using as a discount rate? Either the cost of equity, if you think about taxable income, or the cost of capital. I can live with either, but that's what you would use to get the And this is why when bankers just take the NOL and multiply by the tax, which is often a practice, they said, that's your tax benefit. They might be missing the point. That might be the tax benefit. We have immense amounts of income today, but it's definitely not your tax benefit if you have to wait over time. So bottom line is, synergy is a nice sounding buzzword. But if you're going to pay for it, you have the obligation to be explicit about where the synergy is coming from and try to balance. It's common sense, because if you don't, you're going to do what Procter & Gamble did. Pay whatever the extra is because there's synergy out there. Talk about pricing. If you take an M&A class, often when they do pricing, they look at transaction multiples. See, what's a transaction multiple? You know how when you do PE ratios, you take every company and you could get the PE ratios? With transaction multiples, you look at only a subset of companies that have been acquired in M&A transactions. I want you to file that away. Think statistically, does that create bias? So here's what I do. I come to you. Remember, I'm still trying to get you to pay more than 60 million. So I come and say, you know, forget all this DCF stuff, forget synergy, forget control. You should pay 100 million because people pay 5 times EBIT in other transactions. And I show you a list of 15 other transactions where people had paid. What do you think about that? It's pricing, right? Pricing is okay. What is it about this pricing, though, that makes it a bad pricing? Justin?
It's only the deals that get.
You take the deals that have been done, and basically you're looking at what acquirers paid, and we know acquirers had these premiums on. You create a subset. It's not that it's bad, it's pricing, but it's pricing with a really bad sample, a biased sample. You know, when I see this in M&A, I say, just go back and show me the pricing for the entire sector. Don't pick and choose transaction multiples, because then I'm set up to pay more than I should. Then I say, okay, I know you don't like it. What if I do 5 times EBIT in year 5? Pushing off a bad decision 5 years might make a present value effect, but still a bad choice. So when you look at pricing, you've got to be careful about how, so ask questions which are statistical. What's that sample? Am I getting sampling bias? Why did you pick this multiple? Remember, the person who's selling you this multiple tried 4 and picked this one. It's good to keep them off balance. Say, have you tried value to EBITDA? How about EV to sales? Right? Get them off the script, because you want to see how much of this is scripted. So I'm at the end of my tether. I've tried everything. You're refusing to pay more than 60 million. So I hit you with what I think is the word that will convince you that this is a good deal. I tell you that this deal is accretive. I think this word should be banished from business and finance. What does that mean when I say it's accretive? I'd love if that were the reason. That's a good thing, but accretive is actually a much simpler test, Mladen.
It increases the earnings per share.
It increases earnings. That's it. So let me ask you a question. What kinds of acquisitions increase your earnings per share? Accretive acquisitions. This is the circle we go in, right? Let's go think in terms of PE ratio. Let's say your PE ratio is 20 as a company, and you're looking at target companies. What has to be true about the target companies for a deal to be accretive? The PE ratios have to be less than yours or higher than yours. So basically, anytime you buy companies with PE ratios lower than yours, the deal will be accretive. And it's just pure math, right? Is doing a deal with debt going to be more clearly, right? So basically, you're saying if I use debt and buy companies which have lower PE ratios than mine, I'm going to be a good company. In what universe is this a great idea? Accretive, dilutive, terrible things. No. So if anybody brings this is an accretive deal, cast them out. Send them to an island, let them be a character on Survivor or something. Do something to just get rid of them. Because this is not where you want the conversation to go. So when you look at pricing, I'm okay with it, but don't do a biased pricing. And and those biased samples will always show up as numbers. And don't use words like accretive, dilutive. To give McKinsey credit, and this was before McKinsey went off the tracks in terms of, they got caught up in this strategic baloney stuff in the last 5 years. When they actually looked at accretive versus dilutive deals and followed through and discovered that dilutive deals actually created more value in the long term than accretive deals. So this accretive dilutive has become essentially a false signal. So don't be a lemming. Don't go along because everybody's pushing in that direction. Don't go with that pricing because you've used the transaction multiples. Push back, ask questions, because it's too late after you paid the price. So at this point, you're refusing to budge, right? What are you? You're probably at the top, not even the CFO, but somewhere in the finance. So I say, you know what? I know you're a very sensible person. And I have to tell you, your CEO really, really, really wants to get this deal done. You say, but that shouldn't play a role. Come on. You want to keep the CEO happy, and the CEO really wants to get the deal done, and you're the last person blocking the deal. This is not good for your future or where you're going to end up. But this is something that I think has to be factored in. The CEO wants to get the deal done. He or she thinks it's worth 100 million. I can almost guarantee you're going to end up paying 100 million. If you don't agree, they'll just fire you, replace you with somebody else. You're a bank that says you shouldn't do this, they go to a different bank. And this is why I think it's easy to blame the bankers because they're the one. But the reality is this push towards bad deals starts at the top. And you say, why would the CEO want to do a big deal? Because it's not his or her money. You want to build an empire as a CEO. You want to be the CEO of the biggest company in the world. Guess what? You're going to be buying other companies just to make your company bigger. You would like to spend more time in Aspen? You're probably going to try to buy a company in Colorado, move your headquarters towards where you'd like to ski. You see, that's very petty. CEOs do all kinds of things for self-interest, but mask them on, I'm doing this because. So when you look at, CEOs and you look at where acquisitions originate, one of the things you find in common, I talked about serial acquirers. You know what, the one thing that you see in common is a CEO at the top who's an acquirer. Because as they move, the companies they move to become serial acquirers. And those CEOs who are heads of serial acquiring companies tend to be overconfident people. They're the people, remember in high school, these are the people who think they know everything. They're actually pretty stupid, right? But they're the big person on campus that throw their weight around. They may state opinions with no facts. No, but people bend to them. I would love to tell you bad things happen to these people because you want bad things to happen to the people. But they're the ones who end up as CEOs of companies. Because that bluster and overconfidence, it's amazing how high it can take you. And the only thing that brings them down is their own overconfidence. CEOs make decisions on things that you look at and say, really? That's why you bought this company? And there's one more thing, and I think this was brought up in the last session. What if I don't do this, my competitor will do it? It's defensive acquisitions. Right? If you're in a business where the only way you can survive is with defensive acquisitions, my advice to you is this is not a good business to be in. Shrink and go away. Let other people make the mistake of saying, the only way I can be an airline is by buying other airlines. Go for it. It's other people's money. So as you go through, you're going to see this process play out because many of you, even if you don't end up in M&A, are going to see this process swirl around you. Recognize how much of this has nothing to do with the numbers. So egos, overconfidence, investment bankers, there's a tremendous amount of force that's going to push to get the deal done. And I'm not going to tell you it's going to be easy to be the person pushing back, but at least get your thoughts down on paper. Say, this is what I think about the deal, because you don't want to be the person who 5 years after the Time Warner AOL deal say, oh, you were in that group that pushed the deal? He said, no, I was the person who said you shouldn't do the deal. Okay. So that's part of the process. Yes.
I have a question. Defensive acquisitions.
Yeah.
Let's say for an airline company, you bought for airline, right? And you get a better market share. Then you have like a.
But first, let's pause there. What market share by itself, the proposition, market share by itself doesn't do anything for my cash flows or my risk. So complete the story. What is market share supposed to bring? That's good for you.
I mean, like you can have like better margins. You can charge better.
No, but you have to have pricing power, right?
Yeah,
In the airline business, do you think having higher market share has brought pricing power? Think back. I've been watching the airline business, and you know why it doesn't show pricing power? Because new airlines keep popping in where these essentially seem to be, I don't care. I'll say, this is a business where people have gone for higher market share, hoping that they will get pricing power, and it never manifests. So if you did get pricing power, I'm okay with that because that's a real effect. It's a synergy effect. I'm willing to build it in. But I'm saying don't do it without checking to see if higher market share will give you pricing power. Because if it does, I'm okay with it. That's not a defensive acquisition. That's a very growth-oriented acquisition where you're essentially saying, if I do this, my margins will go up. Yes.
Like, for example, I think if you analyze it and you put it into practice, probably 90% of the deals shouldn't go through. Or
Of
90%,
public to, not 99%, it's not that bad.
or
right?
80, I
Eh,
don't know.
Or the deals will go through at lower prices, right? Because remember if you did this right, Procter and Gamble, if it had bought Gillette and paid a $15 billion premium, that would have been a good deal. So it's,
Maybe it wouldn't-
I'm sorry,
Maybe it wouldn't have been accepted.
in which case you walk away, but then you could, but if you were more selective, because you have a lot of money, you can go around checking other companies. You might have done 5 other deals, smaller deals. Maybe the problem here was you went after a big company and you paid a premium on the market price. So we'll map out where you're likely to succeed with acquisitions. It's not that dire. But there are certain kinds of deals that are more likely to fail when you apply this test than others. And we have to look at what kinds of deals those are.
But like, for example, when you look back, I remember when Facebook acquired Instagram and everybody.
And that I never understood that tomorrow. How much did they pay for Instagram? 1 billion, right? Facebook was already a $100 billion company. Was Instagram a public company or a private business?
Right.
It was a private business. We'll talk about why those kinds of acquisitions, you don't find the same kinds of bad deal problems. Okay? You've essentially described the kind of path where we can actually win through acquisitions. Microsoft bought what, 45% of OpenAI. I don't even know what they paid for it. Probably 3 billion, 4 billion, some tiny amount. It's turned out to be a great deal for Microsoft, right? We'll talk about why some deals can create, have the structure, but it's not going to be 99% of deals, but it's going to mean the types of deals you see will start to change. Question?
I was actually about to ask the same thing about that, where it's like, how do you value intellectual property? That.
Come on. At the end of this guy, what's the value of intellectual property? Where does it have to show up? Cash flows and growth, and if it's something, no, there's nothing really different about IP as opposed to a physical asset, right? I think that's not the issue. It's not that you're buying intellectual property, it's you're paying market price plus. That's really at the core of the problem. So if you buy intellectual property at the private business level, you're far more likely to get a good deal than if you're buying intellectual property in a public company where the market price already reflects it and you have to pay a premium. Which brings me to my final point about accountability. HP is a master of bad deals, right? This is a company that made this an art form. So this was about, 15 years ago. They buy this, and this was actually a company called Autonomy. It's a UK-based software/consulting company. They paid $11.1 billion for the company. So at the time of the acquisition, I tried to build up to how they got to it. So this was my build up because all you observe is the price before and the end. So I started with the book value of the company, which was 2.1 billion before HP showed up. So this is Autonomy's book value. So they get targeted, and this is HP is paying 11.1 billion. The first thing you do after an acquisition is you call the accountants in to reappraise the value of the existing asset. So they do that book value dance, and they reappraise the value by adding another 2.53 billion. They claim to have found 2.5 billion in undiscovered value. The book value went up to 4.6 billion. Now, from the 4.6 billion, they added a premium to the deal to essentially get to 5.9 billion. That's the market value. They paid a $5.2 billion premium over the market value. And of course, they used the usual words, synergies, strategic considerations. This was when Carly Fiorina was the CEO, or was it Meg Whitman? Was the CEO of HP. 2 years later, the deal falls apart. It falls apart for lots of reasons. HP claimed it fell apart, but at the time of the deal, it was justified. And this was one of the few deals where everybody looked at the deal and said, you guys are paying way too much. Even the equity research analysts who usually go along with the management said, this is an amazing deal. So this was Leo Apotheker, who ended up being the CEO of the company at the time the deal was announced. He was in front of a group of equity research analysts. And I'm going to read his words because I don't want to misread them because these are the words he used. He said, so an analyst asked him, why did you pay 11.1? He said, we have a pretty rigorous process inside HP that we follow for all our acquisitions, which is a D.C.F model. I have a sense that if you asked him, can you expand on that acronym, he would not have known. So some aide said, go out there and say, use the DCF model. As if that, that's cover, right? You use a DCF model, you must be doing everything rationally. After this class, that's not necessarily the case. And referring to discounted cash flow, a standard valuation methodology, which sets it's not a valuation methodology, it's a philosophy of thinking about what drives value, but we'll let that go. And we try to take a very conservative view. Okay. I thought you have to use expected cash flows, but I guess you missed that part of the DCF. And then he went on. He should have just stopped because he couldn't stop himself. He said, just to make sure everybody understands, autonomy will be on day one accretive to HP. Oh my God, this is such a relief now that you've told me it's going to be accretive. Just take it from us. We did the analysis at great length and great detail, lots of greats in there. And we paid a very fair price and we'll give a great return to our shareholders. Too many greats here. Should get a little suspicious. A year later, the deal falls apart. They write the 11.1 billion down to 2.3 billion. This is the goodwill impairment for the ages. So when it happened, I decided to assign blame. I said, when you make this big a mistake, it wasn't the janitor who made the mistake. Somebody is responsible. Who is it? So I went through the pieces. At the time that this deal fell apart, HP claimed it was because of accounting irregularities at autonomy. That's why they overpaid. So I said, okay, now let's go through the steps. So I started by looking at the synergy that they paid for. And it turned out that there was no synergy. The revenue growth was not there. The margins didn't improve. So I said, some of this is just bad management, right? So the primary culprit is, Leo Apotheker. The secondary culprit, of course, are the deal bankers. So let's start by stripping them off their fees. You told me there's 5.2 billion. In any real world business, if you told me there's a $500 benefit and I get nothing, I would say, give me back the fee I paid for it. It's not going to happen. None of this is all, I wish this would happen, but it doesn't, right? Second, they blame the accountants. And I said, okay, you're right. The accountants did play with the numbers, not by as much as you claim. Well, the accountant, I think, was Deloitte. Let's make Deloitte kind of disgorge some of the money that they've collected for auditing and accounting fees, 1.3 billion. The remaining write-off came from just basically the company being mismanaged after the deal to the point that people left, the staff left, they lost human capital. So you get from 11.1 billion back to 2.3 billion. There are plenty of people, the bankers, the management of both companies, the accountants to blame. You know how many of these people actually had to give back? None of them. And that's, to me, what the problem is in the process. You want to stop the screw-ups in M&A, start punishing people when they do bad deals. Because as long as you do that, you don't do that, you are going to see more bad deals go through. So here's what I'm going to do. I'm going to give you that glimmer of hope on acquisitions by giving you choices. And you have to tell me with each one, if you're an acquirer, which one gives you a better chance. So think as an acquirer, you want to create value for your shareholders. You have to do acquisitions because that's the way you grow. Would you rather be a sole bidder or in a bidding war in an acquisition? Sole bidder, right? And we look at the evidence of what happens when you have a bidding war with a sole bidder. It's damaging. And we'll talk about why people don't take that advice and say, if you're in a bidding war, just drop out. Second, would you rather buy a public target or a private target? Tell me why. What is it about public versus private? Now, and keep the sizes the same. Two companies, both $10 billion companies. One is public, one is private. What is it about the process that makes your odds better with the private company? No, but let's say keep all the operating details because in a sense it might be, there might be good, but that should be operating details. I said.
The price doesn't move while you want to
With a public company, what do you have to start as your bottom line and build up from? The market price. What's in the market price? Who knows, right? Markets build in all kinds of stuff. With a private company, what do you start with? You start with negotiated values. Remember the thing we did with the two companies? You start with public market prices and you build up, the odds are already against you because you're starting with a number that already might be reflecting all the amazing things you can do. Would you rather pay with cash or pay with stock, assuming you have both on hand? It's a tricky one. Pay with cash. Depends on what I said.
If the acquisition will have like a higher positive NPV or.
But the NPV can't change based on, the NPV is based on how much you pay, right? Not how you pay for it.
Guess how much you value your stock.
If you think your stock is overvalued, you're saying, I'm going to be tempted to pay with stock. So if NVIDIA right now feels it's overvalued, wants to acquire a company, say, let's pay with stock.
But as you said, like overvalued or the value based on what? Because, like,
On base, I mean, let's say you have a sense of intrinsic value for your stock, right? So if you think your stock is being massively overpriced relative to intrinsic value, it's cheap currency, I'll pay with stock. We'll see why that's not always a slam dunk, because it's a signal you send when you decide to pay with stock and you have cash on it. So think like the bidding company shareholder, and I say, look, I'm going to pay with stock, your antennas start to quiver, right? If you're paying with stock, it must mean you think it's overvalued. This is game theory. So what do? I push up the premium, and because I say you must be paying with over. So we'll see what the net effect is. It's, it depends on whether you're buying a small company or a big company. Would you rather go for a small target relative to your size or a large target? Mergers of equals or mergers of unequals? Where do you think the odds are in your favor? Small, and for lots of different reasons. You bring two companies together. It's like a marriage of elephants, right? It's going to be very, very, very difficult for the two elephants to move anywhere. Now, there are all these issues, cultural issues, two companies, very different cultures. That's the problem, is as you get bigger, you have to buy bigger and bigger targets. And maybe that's the reason acquisitions actually, Cisco in the early 90s created value from acquisitions. By the time you got to the late 90s, it was struggling because as a $200 billion company, think of how big a deal has to be at Apple for it to even be noticed, right? It is subsumed in the larger company. Would you rather go for a merger driven by cost synergies or growth synergies? Where do you think your odds are greater? It turns out that cost synergies, your odds are better. We'll talk about what is it. It is about the process that makes cost synergy, because it's a purely empirical one. There's no theory reason. But in cost synergies, what are you going to do? You're going to cut costs, right? Growth synergies, you're talking about projects you might take and markets you might conquer. Cost synergies, you got to be concrete. We're going to close 200 stores, and it's easier to follow through. So in fact, the evidence suggests that this is sole bidder versus multiple bidders. The way to read this, and this was the way old finance papers used to show excess returns, shows you how charts were so extraordinarily primitive. So one of these is so don't look at the base. One of these is the return. So basically when you see the numbers go up, your stock goes up after the deal, and the other one, the stock goes down. One of these is the winner, the other is the loser of the bidding war. Who do you think won the bidding war? So one of these is the winner of the bidding war is the one where you see below the line. The loser of the bidding war is. So when you're in a bidding war and you drop out, investors heave a sigh of relief. Thank you, God, they dropped out. But here's the problem. Once you get into a bidding war, it becomes a pissing contest between two CEOs, right? Neither one wants to walk away from the table saying, no, I'm losing. I want to win. I would love to tell you female CEOs don't have this issue. It turns out that once you become CEO, everybody gets testosterone. I mean, the CEO, they must come in and pump testosterone in. You get this macho, I've got to win at all costs. So this seems to be a phenomenon that comes about because you rise up the ranks and you can't lose anymore. Second, buying small versus big, cash versus stock. I mean, let's face it, if you look across these graphs, so this is the blue is the small, and across the board, you can see small acquisitions do better than big acquisitions. But I've defined small and large relative to your size. But whether you should pay with cash or stock seems to vary depending on whether you're going after a small target or a big target. If you're going after a small target, it looks like, and you can see across different amounts, the mode of payment here is all cash stock. You can see that paying with cash is, with small targets, delivers better results with, and if you're buying larger deals. So it seems to vary depending on whether you're buying a small company or a big company. And you can see why. If you have two large companies come together and I'm paying with stock, you worry a lot. Okay, this guy paying with overvalued stock.
Like, just
Small-
to understand, small companies better to pay with cash, large companies better to pay with stock.
Small, exactly. So small companies seem to be okay receiving your stock. They don't overthink it. The larger the company becomes, the more this game theory kicks in. So again, if you ask me, should I pay with cash or stock? I'm going to say, how big is the target? Because I don't want to get into this gaming war of you say you're going to pay with stock and the premium goes up even more and you end up in this loop. By the time you're done with the loop, you ended up overpaying. And here's, I think, the biggest lesson. You look at buying public companies versus private companies. And I've added another piece in here of not private companies, but subsidiaries of public companies, divisions. Public companies are the worst. So you can see that across the board, right? In terms of return. So, in every one of these, it's the worst. But it turns out that subsidiaries of other public companies is the best. Private businesses are good, but buying divisions of public companies is even better than going after private companies. Why do you think that might be? Justin?
Because the information's public, but not like you can separate it out.
Remember where I showed you the companies you wanted to, the divisions you wanted to divest, and many of you attempted you're the new CEO, you want to get rid of the bad stuff, right? And what do you want for it? Just get rid of it. You can almost see the guy at Ford in 2009 saying, we're in trouble, I am now the new CEO. Get rid of this Jaguar Land Rover, it's not doing very well. How much should we charge? Just give it away. And guess who benefited from that? Tata Motors has spent a decade reaping the benefits of Ford CEO saying, get rid of the bad stuff. So if you're acquiring companies, look for companies where you have a new CEO, preferably one with a big ego, who wants to get rid of the bad stuff. Then act all compliant. I've been watching Shogun do the Japanese thing. Wow, you're the great one. I know you know amazing things. No. You get some amazing deals when companies decide to restructure because they're being advised by strategists, not by people who are looking at, do the numbers work? Strategists say, get rid of bad businesses. At what price? They have no idea. Just get rid of it. And in the process, you're giving away businesses for well below what they're worth. So the bottom line is, you can structure deals and actually make that. And when you look at growth and cost synergies, this is from a McKinsey study that looks at what % of the time companies deliver on growth promises. Now, so if you compare cost synergies versus growth, it's no contest. Companies are more likely to deliver on cost synergies than on growth synergies because they've planned for them before they do it. So can you grow a company with acquisitions and create value? Yes, but you got to be disciplined. Focus on small companies, private businesses, assess value, try to negotiate. But that discipline is going to get more and more difficult to maintain as you succeed and become larger, right? Because the process itself will start to implode on you because your targets have to become bigger because you become bigger. So you're going to find this process that you can have companies that look like stars. Now, Cisco became a case study in Harvard in the late 90s as how you can grow value through acquisitions. And that should usually be the kiss of death. It's like being on the cover of Time magazine, right? Your Harvard case study has been, and spend the next decade destroying value through acquisitions. You have to know when to stop. And I think that's partly what is so difficult in the process. Yes, Vice.
Can you say that Amazon has been successful like go through acquisitions?
What acquisition has Amazon made other than Whole Foods? I'm sorry?
That is successful.
Even Whole Foods was a tiny company. If you think about it, I don't think you'd have even noticed Whole Foods when they bought it because it was like $15 billion company and $1 trillion company. Amazon has never bought a large company. So I'm not even sure. I mean, Amazon is not the kind of company that has grown through acquisitions. It's a company that's grown primarily through organic investments. They built a logistics business entirely from scratch, right? They built an entertainment business entirely from scratch. And maybe that's the lesson. Great companies don't get to be great companies by going out and doing big acquisitions. They get to be great companies because they pick good investments, they build them up. I mean, it's that old thing, that advice that grandmothers give, which is if you build something, you will, but if you go let somebody else do it for you, you're not going to get the same upside because then you have to pay that person upfront. So you can grow, you can do whatever you want to do, but if you're not disciplined, the thing is going to blow up. David?
Can you give an example as to how it works to improve synergies?
I'm sorry?
Like how to do growth synergies?
Growth synergies, basically, let's take a case of a brand name company in the US buying a brand name company in India because they think it's a big market and they think they can take their products and sell them in India. Let's say it's a beverage company, right? Historically, the Indian beverage market has been relatively immune to foreign competitors, partly because those competitors were kept out. So you think you can grow. So if that is your plan, then I'm going to ask you to be explicit. I'm going to ask you, which of your beverages you think will sell in India? What parts of India? How much are you going to try? And you're going to say, but that's still fuzzy. But I think that is part of what delivering growth synergies requires, is being explicit upfront on what form the growth synergies will be. And it can't be just India is a big market, right? It's got to be that you've thought through a portion of the market before you go buy that beverage company. So to take the form of, by buying that company, the combined company is now going to grow more because I can now sell my beverages that sold primarily in the US and India. It's a big market. And you put that into the revenues, the growth, the margins, and come up with a higher value. But I challenge you in an acquisition to actually find synergy being explicitly valued. It's amazing. It's fuzzy. It's thrown in there. The acquiring company never gets into the picture. It's all about the target company. So for acquisitions to work, discipline is the word you're looking for. And discipline is tough to maintain as you get larger and more successful. And I think we need to plan for synergy. And this is my point to David, before you pay the price, and then hold people accountable, preferably the person who's pushing hardest for the acquisition. Say, okay. And you know what? If the numbers don't come in based on what you're projecting out there, you're the first person to lose the job. You'll be amazed at how quickly forecasted numbers come down if you are going to be responsible for delivering those numbers. If you're in a bidding war, just drop out. It's easy advice to give, but you got to overcome the ego effects. And someone, as I said, and finally, I think that, I don't know why this process hasn't created a contingent where half the deal fee should be withheld for 5 years after the deal gets done. You're saying, no banker will work for me. Good, don't use bankers then. Why are you using bankers in the first place? What exactly are they adding to the process other than a fee and getting you to do more bad deals? So that's a synergy, but that's the M&A part. Any questions on acquisitions? Let's talk about value enhancement. First, I want to draw a line between value enhancement and price enhancement. By now, you know the distinction between the two. And I'm going to use 2 studies separated by 5 years to illustrate the difference. The first study came from a paper called A Rose by Any Other Name. And here's what they did. They took, I think, 64 companies in the late 90s that changed their names. You're saying, what's the big deal? Companies change their names all the time. They changed their names in a very explicit way. They added .com to their names, but changed nothing about their business. Now, I could ask you an intrinsic value question. Does adding .com to your name make you a more valuable company? If you don't change your business, cash flows the same. But here's what happened to the stock price. It jumped almost 100% plus. This is amazing. We've wasted our time for 25 weeks talking about cash flows, growth, and risk. Just change your name, right? .ai. Kroger.ai. That doesn't sound like a bad idea, right? You still sell groceries, but you got AI in your name. But here's the catch. This is a study 5 years later of companies that changed their names. You know what they did? They took .com out of their names. What happened? 1999.com was the place to be. By 2004, people were in the other direction. You play, I mean, this is like riding on the back of a tiger. You try to keep the market happy, you give it what it wants, it'll turn on you sooner or later. Most of the time when CEOs are talking about value enhancement, you know what they're really talking about? Price enhancement. Because if they can get the price to go up by the end of the year, they can collect their options and bonuses. There's a lot of price enhancement going on. That's why you see a lot of stock splits and tracking stock. But value enhancement requires that you change something in the company. And we know exactly where you've got to go to change value. You can try to change the cash flows from existing assets. And we'll look at the different pathways. You can try to get more value from growth by either growing faster if you're in a good business or growing slower if you're in a bad business. You can try to lengthen your growth period, which is in a fancy way of saying maybe your competitive advantages can get stronger, something you can do, or maybe you can lower the cost of capital. I know it sounds incredibly prosaic, but for value to change, it's got to come from changing one or more inputs into evaluation. So in the next 15 minutes, you're going to see every word you see in restructuring show up somewhere in these graphs, because if you truly talk about increasing value, it's got to show up in one of those places. Let's start. First up, you're trying to get more cash flows from existing assets. In every restructuring, the two words you'll often see is cost cutting and more efficient operations. And assuming you mean what you say, what I hear is lower costs, higher margins. So maybe that's the place you start. Maybe you're a company that's accumulated a lot of fat. You notice how many layoffs there have been at Tesla in the last few weeks? And then look at the title of the person, and today somebody tweeted out that they lost their job. Their job was something to do with the charging stations. I don't know what the title was, but he was doing something, I guess. Maybe he was doing nothing because Tesla said you can leave. I'm sure the charging station will be completely unaffected tomorrow. But you're cutting costs, and there you can cross the line if you cut costs that are too close to the bone. So that's your first stop. If you've got assets that are not just losing money, but expect to lose money forever, stop. You're saying, why wouldn't somebody have stopped it already? Because people hate to admit mistakes. I saw Giancarlo Stanton come up yesterday as a Yankee fan, and I predicted he would strike out 4 times, and he delivered on that promise. I know how much the Yankees are paying him each year. In any logical world, they should cut their losses and get rid of him. But Brian Cashman, who is, he signed, he's not, the minute you let somebody walk away, you're effectively saying, I made a mistake. So when you get these divestitures, usually when a new CEO comes in, they have no problem admitting to the old guy's mistakes, mistake, because they want to clear the table to make their own mistakes. The next thing I'm going to say is going to sound mildly or majorly unpatriotic, depending on where your standing is, but I'm going to say it anyway. I've never viewed it as the objective of any company to maximize taxes paid to the government. I'm sure Bernie Sanders would disagree with me. So I'm going to cover myself. Within the framework of the law, you want to pay the lowest taxes you can, right? In a sense, there's a lot of tax gaming going on. If you're a multinational, you find a way to move income from high tax locales to low tax locales. Take a look at any European multinational. The Irish subs almost always have the highest margins. Magical. Maybe it's got something to do with the 12.5% tax rate, but I'm sure this is all completely operational. It could be, you heard of transfer pricing? You know what transfer pricing is, right? Within companies, because you sell things and buy things across the business, somebody's got to come up with the pricing across. So when somebody says they're in transfer pricing, you know what they're really saying is my job is to move income from high tax locales to low tax locales. With transfer pricing, you can do that. So to the extent that you can pull this off, and even risk management, you can argue by smoothing income over time, you're reducing the overall taxes. You're trying to reduce the T in. If you've overinvested in the past, you might say, look, I'm going to live off the fat for a while. Some people get, some companies get into this autopilot. We got to build a new factory every year. Hey, people are not buying the stuff from the old factory, just hold off. What does that do? It creates a depreciation still. You don't have the CapEx. So at least in the near term, you can have a negative net CapEx because you have excess capacity. And it's amazing what managing working capital can do to cash flows. Now, until Walmart came along, the rule and this came from accounting classes, is you were supposed to maintain a current ratio of 2. That's what I was taught accounting. I said a good current ratio is 2. What does that mean? Current assets should be twice current liabilities, which means your working capital is always going to be a positive number. It is going to drain your cash flows. And Walmart came along and said, who came up with this number? Why can't we make current assets roughly equal to current liabilities? And they did this with inventory management. Walmart was one of the first companies that created just-in-time inventory. So rather than let things stock up, and they brought their inventory levels, and you're saying, what's the big deal? It saved them $2 billion in cash flows just by taking working capital and making it go from a drain on the cash flows to a neutral effect. So basically, you're trying to get more cash flows from existing assets. That's the first stop. So I'm going to take the second stop. The second stop is looking at growth. Now, if you look at more companies that want to make themselves more valuable, they want to just go for more growth. And sometimes that works, right? In fact, by now, you know the conditions under which going for more growth is going to increase value. If you're in a good business, you earn more than your cost of capital, by all means, go out and take more reinvestment. If you're an airline, don't go for more growth. The more growth you go for, the less valuable it will become. So you're going to try to create more value by either reinvesting more if you're in a good business or reinvesting less if you're in a bad business. But I think there again, you'll have to fight against the tide because many companies, higher growth is always viewed as better than lower growth. In fact, a few years ago, McKinsey looked at different ways of growing and ranked them from best to worst. So they have a huge, and this is one of the great data sets they have of every client they have and what they've done. They looked at value created by different growth strategies, but looking at what $1 million in investment in that strategy create as additional value. And this is from best to worst. The best growth strategy is to come up with a new product. $1 million invested creates between 1.75 and $2 million in additional value. I think this is great. We should all go for new products. There's a catch here, right? When it hits, it's huge. Apple coming up with a smartphone. And Microsoft coming up with a new cloud product or ChatGPT. But it's really tough to get that hit. The second best strategy is expanding an existing market. So, by introducing a new product, there's new service. So essentially, you're going with that $1 million invested creates between 0.3 and 0.75 million in value. The third is maintaining market share in a growing market. Because the market is growing, you don't have to cut prices. You basically can grow by just maintaining it. And then you get to the bottom of the pile. The two ways of growing that historically have had the toughest time delivering values. One is competing for share in a stable market. Why is it so difficult to create value if you're competing for share in a stable market? Mladen, what do you think? Why do you think that is?
If you're competing for share in a stable market,
right.
Well, I would say probably if you have customers that might be sticky in the sense that they have,
But you have to go after other people's customers, right? And how do you get other people's customers to switch to you? You go into price war. So you win the battle of a higher market share. So in your Excel spreadsheet, I give you higher revenue growth, but I knock your margins down. Try it in your company. Increase their growth rate by 3%, lower their margins by 3%, see what happens to the company. And you should be you shouldn't be surprised at what's at the bottom of the pile. Historically, the most difficult way of trying to create value. It's not impossible. Clearly, you can see their successes is acquisitions. And you don't need me to repeat the last session we had. So basically, and as I said, sometimes growing less is better than growing more. And this is a table that I keep, especially for companies that get too excited about growth. It's a table you might have seen earlier in the class about companies that earn a return on capital less than the cost of capital. And this is all global companies in 2023. and you look at the percent of companies that earned a return on capital less than the cost of capital, almost 69% of global companies earned a return on capital less than the cost of capital. Some of them might have good excuses, but and it's gotten increasingly difficult over time to create a business that earns more than the cost of capital. Globalization, disruption, all kinds of forces. So growth, I mean, start as a skeptic. I'm not saying don't say no to growth, but before you sign off on growth strategies, ask about what will I have to reinvest in? Can I earn more than the cost of capital? Now, in terms of, when you think about the length of your growth period in the Excel spreadsheet, it's a number, right? 10 years, 5 years. But if you think about what you're looking at here, it's your capacity to earn more than your cost of capital for an extended period. I am not a corporate strategist, and you probably guessed that by now. But I think this is the one place where, if you think about the essence of corporate strategy, the Michael Porter's, is it 5 forces, 6 forces, 4 forces, whatever it is? The essence of corporate strategy is figuring out a way to create barriers to entry. To get away from that first Econ 101, perfect competition world. In a world where there's perfect competition, nobody earns success returns. And your job in business is to push away from that world to create an imperfect world where you have barriers to entry. So I'll list out 4 possible barriers to entry that you might already have as a company, you might go try to build if you don't. First, of course, is branding. We talked about how brand name allows you pricing power. How do you get a brand name? I'd love to tell you it's marketing and advertising. But with Birkenstock, it was pure accident, right? Hippies wore your sandals. You didn't get them, they just chose it. Kate Moss wore your sandals on that cover of Vogue. She wasn't paid for it. She just, she could have worn boots for all you know, and there's Birkenstock, 20% of its value gone. Barbie wore pink Birkenstock. I mean, a lot of brand name is just being in the right place at the right time. So you've heard of Celsius, this new buzzy beverage company. I was looking at their drinks. There was like bubblegum flavored something and root. It's not my deal, but clearly it's got somebody's imagination. It's this buzziest beverage company out there. Second, it would be nice if the government would be your protector against competition, right? Does it ever happen to a company? Pharmaceutical companies, that's the essence of patents, right? But there are companies where the government can act as your protector against competition. But be very careful what you wish for. Because in return for that protection against competition, they might take away what you hope to use because you have no competition. For much of the last century, phone companies and utilities in the US were regulated monopolies. What does that mean? They and only they could provide power of phone service. This is amazing, right? But in return for giving you that regulated monopoly, what did governments demand in return? How did you set phone company? This is so long ago, you probably don't remember, but it's still true with utility prices. You know that to get a rate increase, Con Ed has to go in front of a regulatory commission. And what the regulatory commission looks at? They look at your return equity. They're seriously the last people on earth who actually believe in the CAPM because the cost of equity comes from the beta and a risk-free rate. And if you earn more than your cost of equity, the regulatory commission says, no, you're already earning more than the cost of equity. You lose pricing power. If you're a monopoly, let's face it, everybody hates you, right? How do you get back at them? You charge a higher price. It makes you feel a lot better. You hate me, I'll charge you 20% more. You're a regulated monopoly. Everybody hates the phone company. And when it comes to a price increase, they give you a 3% price increase. I'd rather be an unregulated comparative company than a regulated monopoly. Switching costs. By now, I make a big deal about stickiness and, but the essence, and I don't blame companies for doing this, is you want to make the cost of switching into your product as low as possible. I have AT&T. Every time I walk by a Verizon store, you can almost see the Verizon guys sensing I have AT&T. They're all lined up, say, come on in, 5 minutes, we can switch you to Verizon. And they will, in 5 minutes, switch you to Verizon. They will offer you this 24-page document. You can't even read the font. You sign it, and then you try switching out. God help you, we've already signed a 24-year contract. The first bond is ours, right? And by the way, we'll come and claim your house if you do this. And we have all your data that we're not going to give to you. And those voicemails you had, no chance you'll ever see them. I don't blame them though, because without it, I'll be switching back and forth from AT&T to Verizon to T-Mobile. Just play off the lowest player. You want to keep the switching costs into your product low, make the costs. This is at the heart of the technology business, which is you want to make that stickiness. And finally, if you have a cost advantage, you're going to be able to get a benefit over everybody else. How do you get a cost advantage? Most companies with cost advantages are endowed those cost advantages. Why does Aramco have a cost advantage? It has nothing to do with Aramco's management. It's because the Saudi government gave them all the rights to all of the oil under the Saudi sands. And there's your cost. It costs you $6 to get oil out of the ground. Everybody else pays $22. You're going to make a lot of money without even trying. But in some cases, companies earn their cost advantages. The Templeton funds were among the first funds to go into Asia. And they had an advantage because they were able to collect the data, learn the Asian markets well before everybody else caught on. And for the first decade, they were able to earn excess returns because they were there first. That's long since faded. So ultimately, when you look at it, so I'm going to end with the last way you can change value. You can change cash flows, you can try to get value. You can try to lower your cost of capital. One way to do it is obviously change the mix of debt and equity. And if you've taken my corporate finance class, we can, and even if you haven't, you can see the mix of debt and equity. But that's not the only way. If you've got mismatched debt, short-term debt funding, long-term assets, get rid of the mismatch and lower your cost of capital. And there are two ancillary ways. Remember when we talked about betas, we talked about products and services which are discretionary having higher betas. If you can find a way to make your product or service less discretionary, you in effect lowered your beta. See, how the heck do I do it? I mean, it's basically at the heart of, connecting you to a product where you can't let go. Let's face it, there are, things that you have now that you think of as non-discretionary that you could really live without, but it is what it is. And if you have a lot of fixed costs, try to bring them down. So think about all four dimensions. This is not about, this has nothing to do with your project, so don't freak out. But you could take the company you value and say, if I ran the company or if somebody better ran the company, what would the value be? My guess is there are levers you can adjust in your company. No company is perfectly managed on every dimension. Even NVIDIA, there are things you could probably change. That's going to become the basis of the value control. And I will do it in the last session. After I present your findings, we'll talk about the value control. But I've set the stage to get them. So I will see you on Monday, and I hope you get your project done and to me and the numbers by Sunday.
Imagine the duration of it actually.